Welcome to Institutional FX Uncensored, your free weekly FX podcast. Listen to professional FX traders, currency hedge funds, and FX brokers from around the globe discussing the latest FX news, trends, and regulations. Be ready to navigate through the uncharted waters of the foreign exchange market like no one else has. Tune in.
Hi, my name is Natalia Hunik, and I'm the host of Institutional FX Uncensored, the weekly podcast. We're starting this series for professional FX traders, high net worth individuals, currency hedge fund managers, and FX brokers from around the world to discuss and debate the latest FX news, trend, and regulations. So live with me today is Dave Floyd from Oregon. Welcome to the show, Dave.
Hey, Natalia, thanks for having me. Really do appreciate it.
Thank you. Dave is the CEO and founder of Aspen Capital, provider of expert FX research and analytics to both institutional and retail clients worldwide. As a successful trader and manager, Dave will share with us, some of his life journey as a trader and how he was able to build a successful business. I think for many people listening in to this podcast episode today, there's a lot of traders, who are looking to build their careers, by either going to an established institution and working there, or perhaps building their own business. So I think many of them will be curious, Dave, to learn a little bit more about your life journey and, how have you been able to monetize your trading experience? And you can share your background, but I know that, you've worked at established institutions as a trader for some time prior to starting Aspen Trading. So explain to our listeners, how have you arrived to building your own business? And what were the strategies that you looked at to monetize your trading experience?
Wow, that's a big question, but luckily we've got some time to go through it. I think I had an experience probably about 10 years ago. A good friend of mine here in town, who was also a very accomplished, more so of an investor. He said, "Hey, let's go have coffee." And I was like, "Yeah, that sounds great." We had coffee. We were sitting at coffee. He goes, "I got to ask you. I'm thinking of launching a newsletter, because I've got a lot of people on Twitter following me based on my investment advice. And this guy's a really solid guy. It wasn't like he just had this kind of fluke idea." And he goes, "I want to pick your brain about how you set Aspen Trading up and what the game plan was." And I said, "Jesse, I got some bad news. It just kind of happened. I mean, it doesn't mean that I wasn't intentional about it. But back in 2002 through 2004, when I was toying with the idea of setting up the company, I'd be quite surprised as to where it is today, or knowing if I knew where it was going to be today back then, I would be actually kind of surprised. But to kind of go all the way back, I got started back in the Boston area. That's exactly where I'm from. That's my hometown.
That's exactly what you see in the background here. Exactly. For those of you who are looking at it.
And, I did my undergrad at Northeastern University. I got my BA or BS in economics. I started off with a traditional Boston mutual fund company called Scudder, Stevens and Clark, kind of that blue blood New England type firm. And that's really where I got my taste of trading. And I was kind of leaning towards it anyways prior to graduating college. But then it was one of my coworkers somehow landed a institutional sales trading gig with Standard Chartered Bank out in Los Angeles. And they had an office in Los Angeles and in San Francisco. Long story short, I knew I wanted to go the trading route, and that seemed like the most obvious way to kind of get out of the traditional management style, which I wasn't interested in. I wasn't interested in becoming a CFA, even though I did the series, the first level. I knew that wasn't where I wanted to go. I wanted to be more dynamic. So anyways, moved out to San Francisco, got that job. I was on the institutional sales desk for FX and fixed income. That really whetted the appetite. And, I think like most of your listeners will know, in a sales trading position, you're not really taking risk per se. You're just, filling orders and maintaining the relationships with the clients. But it was about that time where our quote provider, which at that time was a company called Track Data, and I do believe they're still around, their rep came in and said, "Hey, I got a whole group of guys," and no, when I say a whole group, I think it was about 6 people at the time, that were moving upstairs off of the Pacific Coast options floor to start trading electronically directly with the New York Stock Exchange. Now, again, this is back in 1994, maybe 93, I think 94 actually. And that's really when the whole electronic aspect of trading came about. And that really piqued my curiosity. It coincided with kind of a restructuring at Standard Chartered Bank. It was either move back to New York or take the severance package. And at that time, I don't know, I was probably 25, 26 years old. I took the severance package. I had no interest in going back to New York. Maybe that was a good idea, maybe not, but I knew I wanted to try out this trading thing. And bottom line is I started trading electronically New York Stock Exchange stock. So kind of took what little market experience I had at that time and kind of immersed myself into trading. And I did that from 1995 through basically 2002, intraday traded stocks. And of course, day trading kind of dried up after that. And either I didn't make the adaptation or I didn't want to make the adaptation. I think it was the latter. And I kind of segued back into FX trading, which had, I had exposure to at Standard Chartered Bank. But that obviously came with a lot of challenges. That pushed me out on the time frame scale. I was used to being an intraday trader, and I was pretty darn good at it. And now suddenly I was looking at doing swing trades, and that was a real big mismatch in terms of not only my existing style, but my existing mindset. So without going into all the laborious details, I started swing trading FX. While I had been day trading, I also was a partner in a trading firm. We had our own proprietary trading desk. At this time, I'd since moved down from San Francisco to La Jolla, California. We probably had about 10 or 11 folks trading on our desk. And just through local press and a few other things, I started kind of getting a following on the web about, being a trader who could, give good insights on the market. And I kind of translated that into what is Aspen trading now. Some of my old contacts at Standard Chartered Bank and the clients that I'd met there were interested in what I was doing in the FX and trading space in general. So Aspen Trading Group actually was kind of came about by people reaching out saying, hey, you got any thoughts on X, Y, and Z, or you got any thoughts on the FX market? So I'm oversimplifying the whole process, but that's kind of how it came about. And so to answer your question directly, I started to monetize my experience, not only for my own personal trading, which I still continue to do to this day, but I started to put my thoughts down on paper, so to speak, and push that out to clients. And, at this point, we've got a complete global distribution. We've got clients on every continent but Antarctica. So I think we've done pretty darn well. We've got a good mix of retail and institutional. At this point, we've really morphed more into kind of higher end retail clients. Institutional, the game has changed so much, as you know. A lot of people aren't as willing to pay for research, but we do have a handful of pretty prominent institutional clients in our database. I can't mention them just because of confidentiality, but names that when you look at it, I'm like, damn, if they believe in what I'm doing, I must be doing something right. So the only thing that's really changed in the last few years is I've taken the research that we do, because we constantly got inquiries from our clients saying, hey, I'm looking to move out of the field, I'm retiring, or, hey, I don't want to be a full-time trader anymore. I love what you do, but I don't have the time to do it. So we started basically taking whatever was executed or whatever was highlighted in the research in terms of a specific trade recommendation and basically drop those same trades into a managed account. So same research gets distributed into two different silos at this point in time. And that's kind of where we're finding our sweet spot, here in 2021. People still want research for sure, and they're willing to pay for it. But we're finding more and more people, especially on the retail side, once they realize how challenging it can be to do, even if you're getting somebody spoon feeding you the research, the bottom line is, what? Why don't you just do it? I got a text from you the other day saying you were closing that position and I was in a meeting, or I was dropping my kids off somewhere, or I was in a conference call, or I was asleep. I'm in a different time zone. So that's kind of where we are at this point in time in terms of Aspen Trading Group, research and managed accounts. So I think I probably did that in under 5 minutes. And
that you did very well.
I'll come up for a breath and we'll we'll continue a dialogue instead of me just talking at everybody.
Yeah, it was a great answer, and there's so many things to follow up on it. I mean, so it sounds like when you did that pivotal switch in your career, I mean, you were still at a young age where you could probably afford it, and there was the right timing. For probably many reasons, which is something that I kind of picked on just listening to you. And another point I wanted to make about your subscription list. I mean, you obviously are. There's a lot of subscription market research newsletters out there. And I was just curious, what do you think made subscribers to come to you? I mean, was it because, you included some alternative, investment maybe, or like an FX as a, asset class in your research? Or was it because you actually did put a lot of time into, building your own personal brand by, you mentioned that, you attended, conferences. And right now, I also listen to you a lot of times on, other podcasts that I'm subscribed to. So you're doing the best of your time and, putting your name out there. And the reason why I'm asking this question, I'm sure a lot of listeners, let's say they contemplate this idea for themselves. And I just, wanted you to share a little bit more about your, maybe in the hindsight, you've done some analysis to see what happened that, made all the things align for you at the end.
Well, I'm actually really glad you answered that question, because I think it's one of the challenges in the research business nowadays is that information is so ubiquitous. Everybody has access to so much information. The challenge is what do you deem reasonable? What do you take in on any given day? Because it's like drinking from a fire hose. Yeah. That wasn't the case maybe 5 to 7 years ago. There was still there was still kind of a line between information you could get access to and information you couldn't. Mm-hmm. Now, in my opinion, I think it's wonderful. Kind of the democratization of all this information is great. But I think to those who are, let's say, newer to the industry, it makes it really, really challenging to know who's putting out the right information or good information, not the right information, mm-hmm. but good information. So, quite frankly, my business is I kind of took the route, whether consciously or unconsciously. It's just more a function of who I am as an individual. I didn't go the grand marketing scheme route. Those guys and gals that do that have businesses much bigger than mine, but they go through a lot of churn. And I've always looked at those businesses going, great marketer, lousy trader. That's its own type of business. And then you've got the guys, what I would consider on my side of the fence, which is great traders, great analysts, but they don't have this lofty marketing budget. They get recognized by peers who see value in their work. And that's the kind of business model I like, because those tend to be very sticky clients. They're relationship oriented, and what you're putting out is seen as value. Whereas in the other model, you have 1 or 2 losing trades in a row, they suddenly think you're the worst trader on the face of the earth. And of course, it's unrealistic. So I think a lot of people have to look at it as, one, where are you getting your information from? Who's the person pushing out the information? And then for those of you that are, have carved out your own niche as a good trader or a good analyst, if you're looking to set up your own advisory service, if you want to call it that, mm-hmm. you really got to think long and hard about which route you want to go. You can spend a ton of money on marketing and be the expert marketer, but you're not going to be the great analyst. So it's one or the other. And I went with the former route. And that's how I'm comfortable being seen. I don't want my friends from college and grad school to see me putting out ads about, trading.
You don't want to be on Bloomberg TV? What's that? In the ads. You don't want to be on Bloomberg TV?
Well, no, Bloomberg's fine, but I'm talking about some of the more, ridiculous ads you see on YouTube all the time.
Like a billboard sign?
Billboard signs, or, some guy trading from his Ferrari. And I'm just like, oh my God, really? But that appeals to some people, and that's fine. That's a whole different marketplace.
Right. So let me ask you, do you still, just do the marketing yourself, as you mentioned, just, marketing to your peers, or do you have an outside or maybe third-party marketing that helps you marketing team?
We've gone down a couple of routes on marketing in the past, and quite frankly, just really, I think you either have a large marketing budget and put out really quality research, or you just put out quality research and do a lot of networking. I've gone for the latter. Whenever, obviously pre-COVID, we always got our best and most sticky clients by doing, attending conferences or putting on our own little mini conferences in cities and inviting either our, both our clients and people who might be interested. You go out and have drinks with those folks after, and next thing you know, not only are they a client on the research, but then they might become a client on the money management side. And, now with COVID lifting, I want to go back to doing more of that, being on the road 5 or 6 times a year, going to London, going to New York, going to Singapore, those types of things. I'd rather acquire the clients that way. And that just fits my personality. It doesn't mean that's the right way to go, but it's the right way for me.
That's great. That's a more of a relationship based approach.
Yeah,
it sounds like. So I wanted to touch upon something that you mentioned answering the first question, and that's about how your business bifurcated, and you also have now managed accounts program where people can actually put action into your trade recommendations that you send out in your research. So I've noticed on your website, you also have a copy trading product, and that piqued my interest because I do see that as a global trend in FX. A lot of FX brokers are putting out this, copy trading or, software out there. And when I looked at Statista for the kind of the breakdown of globally passive versus active investors, it looks like, the majority of 53% are passive and, into passive form of investments. And I was curious about your thoughts on it. Do you think it's the next trend? I mean, are more people kind of getting into, such asset class as FX? And, they don't have time to do their own research. They'd rather just, copy a signal or copy someone else's advice. Anecdotally, I've heard from some broker stories where there's a signal provider and he had the 10,000 subscribers, and then the signal provider switched the broker, and all of a sudden the next broker has 10,000 applications for new accounts from those followers within the next week. So what are your thoughts on this? Do you see this as an emerging trend? I mean, I don't know if it's an emerging, might have been around for a while. I mean, that's not, I think in 2020 it reemerged, but I think it's, it definitely has been at least in the FX for, number of years, 5, 6, 7, maybe.
Yeah, it's been around for a while. So there's a couple of different angles we can go there. You had a lot of good nested questions within that overall question. So I appreciate that. From looking at what's happening in the industry now and talking to some other people that are, let's say, on the marketing side, because I've talked to a lot of different people, not just traders, but I talk to people in marketing and talk to people in copywriting and all that stuff, people that I've run into over the years. And they're actually seeing, this ties into the first question, which is passive versus active. Yeah, passive investing seems to be quite popular. I think it does have some risks. And again, only so many people can do that before you maybe get lopsided. And that's a conversation that we could have in a completely separate podcast. But, at some point, you still want to have diversification within your portfolio. So even if 53% of the people at these brokerage firms that you cited are choosing passive, some of them may still want 5, 10, or 15% in an alternative asset class, like a managed account with me, with FX and in futures trading. So again, I would never say, hey, stick your whole 401k in what I'm doing, but use it as a diversification measure. Maybe you can get some uncorrelated returns. Maybe you can dampen the volatility, et cetera, et cetera. But I think, what's happened with the whole thing in terms of like Robinhood and whatnot, bringing in a whole new generation of investors, I think eventually as these folks go through the learning curve and realize it's not like shooting fish in the barrel, and they realize, wow, this is actually...
Maybe in 2020 it was, but I'm not sure if that's sustainable.
At some point, yeah, of course. I mean, there's always those pockets where it's like you just put the net in the water and you get a big harvest. A portion of those people are going to stick around because, one, they're really interested and they've got the right aptitude and attitude to stay in the game. Those might be the people that would look at something like a trade replicator or copier service and say, you know what, that makes a lot of sense. I'd like to have that because I still have my day gig. I understand what's going on. I know enough now to understand what that whole process is. I'd like to take part in that. I think the big thing that that's going to kind of hopefully define the industry. And I don't think I'm the first one to do it, but I'm going to be the first one kind of beating our chest about it, is making sure that the trade replicator performance is the performance is posted by a third-party provider. Because as you know, in a replicator service, the client determines what their lot size is. So even though everybody gets the same signal, you might have one person in Albuquerque, New Mexico, who goes really aggressive. You might have somebody in London who's more conservative. If the trade wins, of course, they still make money, but you're getting a different approach. So you can't report a uniform performance for all of your clients, but you can report performance based on a simple measure, like, hey, we risked 2% of the trading capital on this trade, and here's what the results are. And we're going to be doing that using a third-party service that is connected to the master trading account. So everything that's reported, we don't touch. That's, whether it's good or crap, it's going to get reported. And I think that's how most people are going to get comfortable with this, because the way it is right now, people put up numbers, and for the most part, they're probably accurate, but you just don't know. And I want to really kind of change that. I want to basically have everybody put their hands out on the line, or put their neck on the line, and whether you're good or bad, let it be known. And I think that will really change the whole tone of the industry and make it more accessible, and allow people to come in and say, you know what, I know these results are legit. I know that I could have ramped up the performance, or I could have scaled it back depending on my risk tolerance, but at least I know what I'm looking at is legitimate. And I think that's one way we can really push the industry forward and kind of take it out of the kind of the wild, wild west, which is what FX was 10, 15 years ago. And we're seeing elements of that again in terms of cryptocurrency, and then now kind of the trade replicators coming into fashion a little bit more so.
Yeah, definitely. We can shoot another episode about transparency in the market. But
it's
there's a lot to talk about. It's definitely an interesting phenomenon. I agree with you. I think a lot of those records definitely need to be verified. And there is, because FX is also OTC, there's a whole other component of whether or not your trade is going to be as successful as the signal you follow, because there's other things at play that have to do with the brokerage and the way it's run and the way it processes your orders and so on and so on. So, that does not guarantee a success by no means, but, at least if you follow the signal that is proven to be successful, I mean, this is a great way to, have another asset in your diversified basket of investments, for certain. Dave, let's talk a little bit about your strategy. I know you trade FX. You mentioned, when we were chatting pre-recording that, you also trade other asset classes. Can you just dive a little bit deeper about, do you trade algorithmically, or you're a micro trader? What exactly goes into your strategy? How do you make those trading decisions?
Yeah. Well, definitely a discretionary trader, without a doubt, mainly technically based, but also a decent amount of quantitative analysis in there. So that might be as close as I get to an algorithm. The quantitative analysis is nice because you can have a third party kind of produce data sets for you that may help confirm or refute what you're seeing from a technical perspective. Most of my trades are what I would call swing trading oriented. They may last several days, maybe a week or two, but not much beyond that. I might be a little bit more active in the S&P futures because they allow for that. But FX is definitely swing trading, and certainly 10-year notes, which is one of my favorite markets to trade. And I mean, I think that's the other thing, I think, for all guys and gals out there that are doing this on a professional level and doing it successfully, I keep my focus really narrow. I think that's really, really important. I trade S&P futures, 10-year note futures, and a handful of FX currencies. The occasional stock, and maybe 5-6 times a year. Mm-hmm. I think, if you go into any successful institutional firm, whether it be a hedge fund, investment bank, or prop desk, you're always seeing people in their own silos doing something. They're specializing, just like in any other field. And I think a lot of people get lost in that in the trading industry. They think that it's this wide open space that they can explore, and they certainly can. But, my opinion is specialization is where you gain an edge. I was just reading an interview with Steve Cohen the other day, and he says, I may not be the best trader in the world. He goes, but I got 40 odd years under my belt. I have perspective. And I think if you trade a very narrow basket of instruments, you get perspective that someone who hasn't done that doesn't have. And sometimes that can be the edge even over these computers and these sophisticated modeling systems.
Right. Yeah, that's a very interesting. There's obviously two schools of thoughts about, the algorithmic trading versus discretionary. But what I've seen, at least, in the institutional FX space, a lot of, successful fund managers are actually discretionary traders with some minimum amount of algo trading, which is quite interesting, though, on the retail side of things, when we're speaking about retail platforms like MT4 and MT5, I think I've seen the numbers recently that the reports were saying that almost like 60 and in some regions 80% of traders using algorithms, which is very seems like a high percentage. It's almost nearly reaching the stock market. I mean, stock market is I think 80-something% automated trading wise. So it definitely seems like the algo trading phenomenon is there and it's growing in FX. I'm wondering, because you traded the FX market for a long time, what do you think are the biggest deficiencies in the FX market itself? You obviously do managed accounts and you prop trade. You probably throughout your career tried all sorts of brokerages, all sorts of platforms. What are your observations?
I think overall the industry's got a lot better. There used to be, as you well know, a lot of really marginal brokers out there that really did a lot of reputational damage to the industry. But thankfully that's long gone. And I think the majority of the brokers out there are all solid financially, and they all offer really great services. And on some level, they're kind of homogenous to some degree. I think the one thing that I still get a little irritated by is I've got relationships with 3 different brokers in terms of accounts. And oftentimes stops get hit in one account, but they don't in another. And that can be just a little frustrating. There's one broker I'm not going to mention. I love using them, but every day at 2:00 West Coast time, they always expand their market out because they have a liquidity pocket is how they say it. I think is exactly how they stated it. And it doesn't mean that that's the true market at that time. But if you've got stop orders that are close to where you are come 2:00 West Coast time, you're going to get triggered out. And I find that such a bunch of BS. And I've had that happen once or twice. And in fact, the other day, I think it was on Monday afternoon, we were getting close to a stop order I had in CAD yen. And I said, I better pull that order, because if I leave it in there, I know it'll get taken out at that 2:00 roll or whatever you want to call that phase in the market transition. And sure enough, it probably would have. I pulled the order and then, of course, put it back in later in the afternoon once the Asian session got underway. But what happened overnight is with another brokerage firm that we had those same orders with, the high was like 1 pip shy of where the stop loss was, but somehow the stop loss got taken out. So I'd like to see that tightened up. I find that really frustrating, because then you've got a handful of clients that are saying, hey, I'm still short. And you got a handful of clients saying, we got stopped out and now prices are lower. That really pisses me off. And I'm thinking, yeah, it should piss you off. There should be more uniformity there. But again, I'm probably starting to talk above my pay grade. There's probably a lot more that happens behind the scenes that I'm not aware of. I just know from the outside looking in, it just seems kind of shitty.
Yeah, I think it just has to do with the OTC nature of the market and the fact that pretty much every broker kind of makes their own market and makes their own rules in terms of trading as well. That's why you probably see such a discrepancy in terms of like the execution and triggering your stops. And I think the market, the price feed itself is just not the same everywhere you go. And the brokers them do their own deriving of the feed or add their own logic there, and that's why it's a little bit different dependent on where you go.
Yeah, and one of the things that's kind of nice back when going back to my standard chartered days, I remember, the guys and the gals are actually the traders on the desk. They look at a client's stop order, and even though prices might have been trading at that, they use their market insight to say, you know what, I think we're just going to hold here and ultimately move higher. And they wouldn't fill those orders. They use an element of discretion. And obviously, if the order went below that, they would still honor it. But in terms of looking out for the best interests of the clients, just because you had one minute trade hit that, everybody got triggered out. I like the way they do that. Now, again, in the electronic aspect of today's market, I know that's not possible. But, it's one of those things that I recall, and I'm thinking, oh, that was kind of nice. You get the call from Goldman and saying, yeah, we didn't fill your orders there.
Right. That was back in those relationship days when, not everything was electronic.
Yep.
Yeah, great. And, we touched upon the trade-in aspect already. I was just wondering, I'm sure the audience would like to hear what platforms do you use to trade FX? And, what are your thoughts on those platforms?
On terms of the execution?
Yeah, in terms of the execution, what you like about them? I mean, you obviously trade other asset classes. Like, how does that compare?
I wish I had some answer that sounds really exotic, and I've got this amazing software sitting on my desk, but the software is pretty amazing. But, it's anything that people have access to. I use the Oanda trading platform for FX execution. I do have to use MT4 for the trade replicator in the managed account. I find that platform to be odd, let's just say. And it's fine. It gets the job done. It wouldn't be my first choice to go to because the way they quote things is very different in terms of lot sizes. It's inconsistent with the institutional background I came from. But I think, it's a decent platform, at least from order aggregation and order dissemination standpoint. But I like the Oanda platform. I would say for the most part, most of the major brokerages out there offer a pretty darn solid platform. And of course, there's other bells and whistles on there, charting, et cetera, et cetera. I think what I would say, though, again, depends on who I'm talking to in the audience here. But if there's somebody listening that's kind of on their way up, an aspiring trader, don't shortchange yourself on good quality data and good quality charting. Yes, all the brokerage firms provide that, but, and it's free of charge, which is certainly nice. Mm-hmm. But, I don't think you're going to walk into too many institutional desks or hedge funds or whatnot. Everybody's using sophisticated analysis platforms, and you're not going to get that type of stuff, generally speaking, on the retail platform. So, if you're doing this, take it seriously. You wouldn't show up as a newly founded carpenter and, have your kid's Fisher-Price toy set with you in order to, fix somebody's fence. You got to go out and buy a hammer and a saw and all the various tools you need. Trading's really no different. You got to spend a little money. You got to have the right tools on your desk.
Right. So you advise to get separately the chart in and, the really good quality one. Yeah.
If you're going to be a technical trader, absolutely. And, a lot of people also poo-poo getting a Bloomberg terminal. But I'll tell you what, while the analysis on that thing might be overwhelming and you probably won't use it most of the time, mm-hmm. It's a relationship builder. You can ping people on Bloomberg that you couldn't email. If you sent an email to somebody, it's going to go into the spam folder. Yeah. You ping somebody on Bloomberg, they're likely to answer you. And that's a huge thing. So again, from a business development standpoint, that's how you kind of, I think, can justify the cost of a Bloomberg terminal.
Yeah, absolutely. So since you've mentioned, the good quality charting, actually, I wanted to see if we can give the audience some practical advice. Yeah. In terms of the news, we already covered, your research, and you also mentioned there's so many different sources of where you can get news from this day and age. I mean, there's information flowing at you from all sides. How do you filter that? Is there any practical advice that you can give to the audience in terms of, you already mentioned Bloomberg terminal, that it's worth the investment. I think that's a great advice. Any other tools or perhaps, media that you can recommend that would be useful for someone who's looking, to become professional investor or is already a professional investor or, aspiring fund manager of where to find the quality information? Because I think the quality is another keyword that we need to focus on, because there's a lot of information, but not all of it is quality. I mean, you can go on Twitter and probably subscribe to some feeds, but it's questionable of whether or not that's a quality information.
Exactly. I think in order to answer that question, it really kind of depends. I mean, if you're a news trader, I'm probably not the guy to answer that, because I find news to be, yes, it's helpful to know, but if I sat here and waited for every little single headline that was accompanying an economic report, I'd either never make a trade because there was another report coming in an hour. So why do I want to get in now? I'll get in an hour. Oh, there's one an hour later after that. Things are going to happen and they're going to impact your trades and you have no control over that. And I think the biggest thing beyond that is, even if you did know in real time, which of course we all have the ability to do, and the numbers better or worse than what the market was expecting, the one thing that none of us know is how is the market going to react. So I find kind of spending too much time on the news a little, distracting. I don't think it adds any value for me. However, then you can go into another and you can talk to somebody else and say, you know what? We have sophisticated algorithms that scrape the news and find things really quick and act on it. Well, okay, I get that, but that's computing power. That's not human power. Now, you could also make the argument, well, hey, I've got the ability to, think it through real quick and really understand what's happening. Well, that might be true as well. So I don't get too hung up on the news. I mean, I don't want to be oblivious, but I don't want it to dictate what I'm going to do. Ultimately, price action is going to dictate if I get into a trade or out of a trade. And if I get stopped out of a trade, like I've got trades on right now, if I get stopped out on what the Fed does or doesn't do today, knowing that, via a news feed isn't going to really change anything, because the market's going to react so darn quickly that by the time I have a chance to go, oh, that's okay, that's no big deal, my stop probably would have been hit. And, again, I guess the only way to say it is I'm not a follower of news to that granular of a degree for where I see it adds any value.
So whether for your research, though, I mean, what type of information are you looking at? I mean, reading at, reading or following, or perhaps using opinions of, people from the macroeconomic space. I mean, do you do any of that?
No, I mean, I do read a fair amount of stuff, not with any, I just read a fair amount online, but it's not necessarily specific to what I'm looking to do from a trading perspective, but I suspect it has an impact in some way. And again, that gets into a whole kind of the ambiguous part of the trade selection process. It's not just something very simple and formulaic. It's, again, your experience, the ability of you taking in information that you feel is relevant and tuning out the other stuff. But to answer your question more directly, for me, my trade generation really comes from price action. I'm looking for areas in the market where there's been lots of support in the past, lots of resistance, maybe some options activity that's giving a heads up to how the market's reacting to that particular support or resistance level. So I'm using technical analysis as my primary guide to get me in and out of the trades. It doesn't usually happen from some sort of a macro idea that then gets disseminated down to the technical. I mean, ideally, you want to have the macros line up with what you're doing. But again, I'm a swing trader. So if I'm only in the trade for a few days or a week or two, the macro trend's important, but it's not critical.
Great. Well, Dave, thank you so much. Last question I'm going to throw in, just because we are talking right now and it's June 2021, and everyone around us probably go to lunch, to the restaurant at your lunch break, and you'll hear a lot of people talking about crypto. So what are your thoughts? Have you invested in crypto? Are you looking at it at all, or you dismiss it as an asset class? What are your thoughts?
It's hard to avoid, obviously, because it's been so in our face for the last month. Do I cover it for my clients? I do, because it has had an impact on the way other asset classes trade. However, that's diminished in the last couple of weeks. But also, do I invest in it? No, I don't. I don't at this point. It's kind of like investing in Beanie Babies or Pet Rocks, in my opinion. But if it's the tail wagging the dog, or even vice versa, you need to pay attention to it. But what I think is happening now is that I'd be willing to bet that the vast majority of people that own Bitcoin own it from 40,000 and higher. The kind of the fear of missing out trade happened between 40 and 65,000. And that's why we're stuck below 40,000. We're actually at 38.8 today. I think there's a lot of overhead supply. That doesn't mean it can't go to 100. I mean, speculative forces can be quite powerful. My understanding is as follows. If it's not a medium of exchange or backed by anything, it's kind of hard to understand where Bitcoin fits in. But that's my very simplistic view. I'm not a crypto expert. What I would say is that what I've been told and what I've read limitedly is that maybe something like Ethereum, which is actually kind of a platform that things can be built on that then has a commercial value. Maybe that's the one that has some staying power in the long run. But I wouldn't invest in these. Maybe I should short them, but I just don't want to get involved. I mean, I've been in the markets for almost 25 years. I've seen these things over and over again. They always are a little different, but they always rhyme. Speculative fervor, then it boils down, and the next thing you know, you never hear of it again.
Right. Well, David, that's a very interesting perspective. I mean, I hear both sides from a lot of different people, and I think we have to record the next podcast episode maybe in like 5 years to find out what happens. Yeah, and then we'll know for a fact of whether it's real or not, if there are any like practical use cases of it or not. But Dave, thank you so much for your time. It was a pleasure to have you, and
my pleasure, Natalia. It was really good chatting.
Likewise, I hope we do another episode soon. Thank you so much.
That sounds good. Have a great afternoon.
You too.
Bye-bye.
Bye.
Any views or opinions presented on this podcast are solely those of the author and do not represent those of Advanced Markets. Trade in foreign exchange or other financial instruments on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to invest, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or more of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with trading and seek advice from your broker or an independent financial advisor if you have any doubts. Anyone opening a live trading account needs to adhere to the laws of their local country, as such laws may differ from country to country. Advanced Markets expressly disclaims any liability for any lost principal or profits without limitation, which may arise directly or indirectly from the use of reliance on information provided through this podcast.